One sentiment I tend to hear a lot from folks is a fear of markets falling off. Makes sense. There's a lot of focus on avoiding losses, but too many people think they'll only lose money on investments when the market goes down. But that's not the only problem, and for a lot, it may not even be the biggest problem. The truth is, a lot of money can get wasted inside a portfolio itself quietly year after year. Handling these issues puts investors and retirees in a better position to avoid wasting money and compounding that waste over time. So in this video, we're going to discuss 3 of the most common ways I see investors waste money inside their portfolio, and we're going to cover what can be done about it. But first, I'm Curtis Crossland of Suttle Crossland Wealth Advisors, and the purpose of this channel is to discuss financial topics and ultimately help people build more tax-efficient retirements. So let's get into it. Now, the first big issue we're going to discuss, and I see this a lot, are fees inside portfolios that end up creating a lot of waste. I see this in the form of higher cost management fees. These are folks paying 1% plus for an advisor that manages their investments. And I also see this in a lot of mutual funds and ETFs that carry what I would consider high expense ratios. Expense ratios are the costs internal to a fund or ETF to maintain or manage the ongoing activity of that fund. All funds like this have an expense ratio, but higher expenses don't automatically mean higher returns. You can see from things like this SPIVA report that over longer periods of time, most active management underperforms its benchmark or index. And just like I'd consider a 1% or higher management fee expensive, I'd also consider an expense ratio at or above 0.5% expensive. This can be an especially big cost area if someone is getting hit by both of these at the same time. Take a look at this. This visual shows the effect of these costs on the hypothetical growth of a $100,000 portfolio. Here we can see what happens over 20 years when a portfolio that should be returning 6% annually is dragged down by high expenses. Note the difference between that top green line and that yellow expense line. It's just a 1% difference, but this is a 1% cost drag. In this example, it ends up reducing that portfolio value by approximately $55,000 over that 20-year period. And while 1% doesn't sound like a lot, by the end of that 20 years, the total reduction in value is about 17.3%. The scary part for me is how often I'll review someone's portfolio and they don't even know how much they're paying. And as I've stated in multiple videos, cost drags have a compounding effect, as we see that in this chart. So what's the fix? Well, the fix is to review your investment costs. Now, I'm sure I'll see a lot of different opinions in the comments section on this, but I want to make a point. A lot of people either can't or don't want to deal with this or manage their own money. For some of you, that doesn't make any sense at all. Why would you pay somebody to do something that you yourself could do? But for others, it's just not their area of expertise. They just don't have the time to do it, or maybe this is the last thing that they would ever want to do. It's why professions like mine exists. If you can do it yourself and you have an evidence-based, prudent approach, then great, don't pay anyone. But if you are an investor or retiree and you're paying 1+%, understand that there are a plethora of lower cost options if you don't have the time, desire, or expertise to do it yourself. To fix high expense ratios, you'll want to research comparable funds. And basically what you're trying to do is see if replacing those funds with a lower cost option makes sense. But be aware of any trading costs or tax impacts before making any changes or doing anything. The second common mistake I want to discuss that can reduce returns over time and create waste is poor asset location. Asset location is the strategy of placing different types of investments into the most tax-efficient accounts to minimize taxes and improve after-tax returns. Think about it. Would you rather have a high-growth stock in an IRA account or a Roth IRA account? And would you rather have a bond or bond fund in a taxable account or an IRA account? Where you place the funds you're going to have as part of your portfolio can make a difference in the after-tax return of that portfolio over time. So similarly to what we have with costs being a drag, tax does in effect the same thing. So two people with the exact same investments, the exact same overall allocation, and the exact same array of accounts can still have different tax outcomes if one of them has poor asset location compared to the other. Some examples of poor asset location that leads to tax drag include some of the following. That could be bonds sitting in taxable accounts when shelf space exists within IRAs, REITs generating ordinary income in brokerage accounts, and high turnover funds creating capital gains year over year. If you take a look at something like Russell Investments' most recent value of an advisor review, it suggests that the value of a tax-aware advisor can reduce tax drag by nearly 1%. So whether you're managing your money or you're having somebody else manage your money, you want to make sure they're doing it in a tax efficient way. And going back to what we saw earlier, here's another visual example of the impact of a 1% and 2% tax drag on returns. This chart coming courtesy of InvestNet. Now, I also can't tell you how many times I've reviewed someone's portfolio that was paying 1+% for management and saw poor asset location. Not all asset management is created equal. So what is the fix for poor asset location? So like before, you're going to want to do a review of your account types and the shelf space that each of them can provide you so you can properly locate the stocks, stock funds, bonds, bond funds, etc. And additionally, as a general rule, you want to try to place stocks into taxable and Roth IRA accounts before any remaining needed exposure goes into things like IRA or pre-tax accounts. Additionally, the first place you want to try to place bonds is going to be into something like an IRA or a pre-tax type account before any remaining needed bond exposure is placed into taxable or Roth accounts. You're going to want to consider your own goals, needs, and costs before doing anything. And especially here, you're going to want to understand what are your capabilities and expertise if you're doing this on your own. Changes here could end up being costly, and not just in the sense of trading fees. If you go to make reallocations or rebalances and you don't know what you're doing, there's a chance you could end up selling something with the intent of relocating it, but accidentally selling something with a very large gain, and then you could be running into all sorts of tax issues in that year. So exercising a lot of caution, or if you're working with an expert on this, you're just going to want to be careful before you make any alterations of any kind. Now, the third most common way I see people wasting money in their investment accounts is through overcomplication. I tend to see this a lot in portfolio reviews where folks will have 10 or more funds or ETFs and they're doing nearly all the same thing. This overlap can create issues not just with your risk exposures, but also lead to added costs. Take a look at this image and you tell me how diversified you think it is. Here's a hint. They're all essentially the same fund, so no, it's not more diversified. Multiple funds can also inflate your expense ratios or costs and create that nasty cost drag we saw in point 1. It can also make rebalancing and managing your exposures far more difficult across accounts or your household. And as I mentioned above, mistakes in rebalancing and reallocations across accounts can end up very costly. This can mean more costly errors or mistakes if you place trades incorrectly, and God forbid you're far more aggressive than you intended to be. It can create heightened fear in down markets, which can lead to panic selling. So what is the fix for this one? Well, it's going to be doing things like paring down unnecessary funds, undoing any overlap, and ultimately constructing a portfolio that has proper diversification and asset allocation targets. If you combine that with low cost, tax efficient selections, you might fix all three of these issues discussed at once. Now, a big caveat to keep in mind with anything investment related is past performance is not going to be a guarantee of any future result. And when you consider what your investments represent, especially if you're in or near retirement, it's often the representation of your life's work and savings. And for some folks, it also represents the goal you might have to leave a legacy to future generations or to charity. Avoiding the decisions that leads to waste is critical because, again, any costs or tax drags your portfolio is unnecessarily exposed to can lead to lower returns, and those drags can continue to be a compounding effect. I'd love to know what your thoughts are on this topic. Have you experienced one of these issues? How would you handle portfolio waste? What are other aspects of this topic you think I should cover? Let me know down in the comments. I'd love to hear from you. And if you're watching this and felt like this is an issue you're either dealing with or have no idea if you're dealing with, or if you're with an advisor who's not as mindful on these issues as you need, be sure to check out our links. At least at the taping of this video, which is January 2026, we're still taking on new clients and helping them manage and plan for their retirements. Once more, I'm Curtis Crossland, and if you want to see how we help folks build a more tax-focused and efficient retirement, be sure to check us out at SuttleCrossland.com and subscribe for future videos.